So welcome to today's class on price action trading. My name is Chris Capre with SecondSkiesForex.com. I was not available last week, and I apologize for that, so thanks for coming back. Obviously, you didn't protest too much, at least not as much as the riders in Greece. And so today I want to go over, because I was traveling internationally, I really haven't been doing too much trading. I was saying goodbye to friends and family in the States. I really haven't been doing much trading, but one trade that did interest me was a move on oil, which I've been watching for a little bit. And so I want to go over this trade from a price action perspective, go through the same process that I went through. And this is kind of what we've generally been doing is my more recent trades, I go through them and really try and take you through the same steps that I went through in trading this. And I kind of break it down from a price action perspective. So I'm going to share all that with you. You're going to see exactly the same stop and limit, entry and exit, and all that stuff. I'm going to share all that with you. And we're going to talk about why I took the trade, what clues there were, so that you can kind of get an understanding of, what it is to trade price action and how you can find these trades. These trades are there. They're everywhere. There's plenty of instruments out there to trade. If you're in the US, there's less instruments because the CFTC has no idea how to regulate things. But hey, can't expect everybody to be on top of their game. So with that being said, these techniques that I'm sharing with you in the class are the same ones I use for trading, same ones you can use, and that's what we're going to be talking about today. So before we do begin, I do want you all to feel comfortable and that this environment is open for questions. We have a lot of people returning here, and a lot of people that are have been coming to this for years. I've been doing this for almost 4 years now with FX Street. I wonder if they'll throw me a birthday party every now and then. But so I've been doing this for a while. A lot of people have been coming back, but some of you are new. And so regardless of new or been here a while, this is a pretty open environment. A lot of people are very cool, so feel free to ask questions. It's a very social group as well. And I'm a decently amiable guy, so especially in the mornings. So let's go ahead and begin today's class. All right, so there's been a lot of big movements in some of the commodities lately, as also the indexes. Currencies, pound's been a little bit choppy. If we look at the daily chart on the sterling, it's been a little bit choppy. It's not a huge range. It's decent. The majority of the price action over the last 5 months has been stuck between 159 and 164. So 500 pip range with a lot of wicks all over the place in between, and only one real spike beyond that. It hasn't been totally consistent. It goes up, it goes down, it goes up, it goes down. Euro dollar has been performing a little bit better. It's been a little more consistent. But it's also been confined to some kind of decent ranges. It hasn't quite picked out a major trend yet. It's only taking minor moves and minor swing trades. One that's been very interesting for me is oil, which I have a particular viewpoint on. But what was interesting about oil is it's had this massive run with very little pullbacks, and then after hitting 115, the thing sold off pretty aggressively, and like silver, consolidated a little bit and then started a sell-off after that. And I've been kind of watching the sell-off, and I was looking around 85 to buy back in. It's a nice little support region. I was looking around that region. I wanted to see what kind of triggers I got, but I was also aware of the upper portions of this range being something that may be interesting, around the 92 level. And so I said, okay, let's, take a look at this. And most of the price action trading I do, I would say 85 to 95% of it is all done on the 4-hour and daily time frames. Every now and then I may glance to a 1-hour time frame, but I don't need to. For the most part, I do all my trading off this. And a lot of times I'm making all my decisions off this. It's interesting. So often I get traders who always tell me, they're like, I trade on this time and this time frame, but then I zoom down in this time for an entry. And I'm sitting there and I'm like, well, then you're not really trading off the 4-hour daily time frame. You're really trading off the 1 hour. You're doing some analysis off that, but you're actually placing your trades based on things that are inside the 1 hour. So you're just doing analysis on the higher time frames, but your actual trading is happening on the lower time frames. And that's fine. A lot of people do that. But to be honest, I don't think you even need to. I can't remember the last time I made a trade off the 1 hour time frame. I don't need to. And a lot of people think, oh, if you're trading off the 4-hour daily time frames, you're going to have huge stops. I had a trade off the daily chart last time that had less than a 40 pip stop, and that was it. And my target was 4 times larger than that. So you can trade off of the 4-hour and daily time frames and have very precise stops. It's not hard. Why? Because the same price action, the same range, highs and lows, I'm seeing those on the 4-hour that you're seeing on the 1 hour. The 1 hour just defines it it's a little more granular. But I don't need that granularity to pick up a signal. They're there. So I've been watching this on the 4-hour time frame, and this was the most interesting part of it. So this is where I really started to watch it. The pullback here wasn't too convincing, and it started to fail around 103, sold off, had a decent push up, but then it started to get really aggressive on the sell, and this is the move I want to concentrate on the most. So it started an impulsive sell-off here. We're talking 3 blue candles and about 8 or 9 red. And this is a 4-hour time frame. So you're talking about 36 hours of selling and maybe 12 hours of buying. And even when it did buy, it was very weak buying. Then we had a decent pullback that had pierced the 20 EMA, and many of you remembered that what I talk about is that the market in trends on these 4-hour time frames likes to pull back to the 20 EMA. If it breaks it, it doesn't necessarily mean reversal of trend per se. What we want to watch for is to see how the market stabilizes after that. Can it stabilize above the 20 EMA? And if it fails to hold above the 20 EMA, then that's what we call a with trend failure. In other words, the market tried to pull back, it failed, and it's creating a with trend signal that's likely going to continue selling off. Well, what I'm going to talk about here is a concept that has to do with price spreads. And this is kind of a cameo out of my new book that's coming out pretty soon. Just waiting for the publisher to finish his part. So price spread is not the spread you're thinking of in terms of, that you get with your broker. That's a broker spread. Price spread has to do with how much price advances upward in an uptrend from peak to pullback, or in a downtrend, how much new ground does it make after it hits a bottom, pulls back a little bit, and then makes new ground to the south side. So a price spread would be something like this. Here we go. We have, from here, 96.23. This is a sell-off. The market pulls back, and then it breaks this low, and then forms a new interim low. And this difference right here would be the price spread. And then we have this one here, it breaks that low, and then it makes another price spread here, 91.45. And then it pulls back and then makes a new low and makes this price spread. Now, if you look at some of these can often give you clues as to how the market is performing on a participation basis. And what I mean by that is how is the price of the order flow behind it participating? Are they increasing in selling pressure? If they're increasing in selling pressure, then the advance should probably gain more ground. Kind of like if we look at candles here and we take a look at this move right here, we can say that from this candle to this candle, this candle, this candle, the overall pressure was increasing, except for this one, because from here we had a small amount of selling, but then the selling increases in size. The next candle is almost about the same size, but then the next candle increases dramatically. To create that kind of selling pressure where the candle expands after each candle, the only way you can do that is if the order flow behind it is increasing on the sell side. It could be the combination of It could be just simply A, more money is piling into the short side, with the same amount of players, but more money is piling in from those players. It could be B, more players are getting into the market, or it could be C, both, more players and more money coming into the market from the players that were involved. Those environments would create increases in the price action to the point where the candles start to expand. They would create that. And that is kind of like a price action price spread. But there is a larger version of that within moves, which we were talking about here. And those also clue us into kind of a more macro scheme as to how the price action and order flow behind that price action is developing. If the price spreads are increasing over a series of 3 moves, then that tells you that all the pressure to the sell side is continuing to increase. If over a series of 3 moves they're getting reduced each time, then that tells you we could be coming into a bottom. At least, minimally, we're coming into a consolidation period. Because what's happening is that the selling is getting absorbed more and more by the buyers. And the sellers are also not selling as frequently and putting in new money. So therefore, the price spreads will get smaller and smaller. And it doesn't really matter whether it's happening because of a support resistance level, a pivot level, Fibonacci level. None of that really matters. It might not be happening for any of those reasons. It could just be the fact that the sellers are exhausted. And the buyers are sensing this, and they're saying, okay, now's the time to strike. In the middle of a fight, you don't necessarily sit there and try and have set increments or set positions where you try and say, okay, now I'm going to counter strike or something like that. No, it's you wait, until you see that your opponent's getting exhausted, and then you start to step up the energy. It's the same thing in sports, same thing in all kinds of things. It's the same thing in trading. And so a lot of times the opposition, whether it's the buyers or sellers, are kind of sitting and waiting for their chance to get in because they want to express their market views and they believe that they're right and they believe they can make money off of it. So they'll wait until the timing's right. And so by monitoring these price spreads, we can kind of get information as to what's going on. Let's take a look at these here. The original price spread here, 96.23, 94.16, it's about a $2 spread, $2.07 roughly. The next spread had increased in size. It went from 94.16 to 91.45. It's about a 260. So we go from 207 to 260 or 270 roughly in price spread. So the price spread increased by about 33%, which is pretty significant. If the next one was to increase, then I would look to take some selling positions. I didn't have a position at this time, but I was looking to take some. I also said to myself, if it begins to reduce, then I want to look at a buy and look for a price action trigger there. And so I looked at the third spread, and the third spread was 91.45 to 89.90. That is it's $1.55. It's the smallest spread of them all. So the thing went from 207 to 270 to 155. It increased by 33% and then reduced literally by almost 40%. That's a huge reduction. So to step on the gas and then pull the foot off the gas with a dramatic deceleration means that it was running into something. Generally, those decelerations don't happen just from profit taking. Profit taking tends to have kind of a more smoother landing, and kind of like a lunar shuttle or something like that, or is landing on the airport on the ground, or something is landing on the moon. It's a smooth landing. But if it encounters a fierce rejection of sorts, which it did right around here, pretty decent rejection, then that usually means it's running into an opposition. And so we're talking about price action from an order flow perspective, which is the general perspective of how I trade. I try and trade not just from physical structures of like this candle and this candle and this candle and this has this and it's shaped like this and that. Those are useful tools, but I also look at the market in terms of time, and I also look at the market. Really, I use all the tools to understand what is the order flow behind it. And to me, it doesn't matter what the market was running into here. It's useful. That's a tool. But it could be a fib. It could be a pivot point. It could be a trend line. It could be anything. What really matters to me is what's the price action and what kind of order flow would be behind that. When you can learn to see past the charts, beyond the charts, that's when you're really starting to understand the market. So most people concentrate on finding just the physical aspects of it, but they ignore the other aspects of it behind it. And that's where they get caught up, because they expect form to equal reality, but it just doesn't work out that way. Form never fully equals reality. If it was, this would be a pretty boring place. It'd be a pretty depressing place in some aspects too. So, with that being said, I then see two price spreads. First one increasing dramatically by 33%. The second one decreasing by 45%. To me, that was a big sign. I started to analyze this a little bit further from here. And I said, let's take a look at this candle, because this candle is pretty impressive. We see an increasing in selling pressure because all the candles are increasing in size, especially from here to here to here. It means that there's, from an order flow perspective, we saw a rejection here, and then we see an increase in selling pressure here, with maximum selling pressure on this candle. So at the moment we got maximum force and selling in this move, happens to coincide with the exact time that we run into one of our strongest rejections. That shouldn't be the case. I wouldn't want to be in a situation where I'm, say, let's say I'm playing American football, and we're giving our fastest runner to charge through that line, and he hits that line at maximum speed, and at the moment he hits that line, he bounces back. That wouldn't be confidence inspiring for me. So that's kind of what happened. I mean, look at this candle. It opened, and it didn't produce one pip higher. It opens at 92.98. It makes a low of 89.90. It drops $3.12. And after hitting that low, it then bounces 90 cents off that bottom. So it bounces a full 25% there. So at the moment we were at maximum selling pressure was the exact moment we came into a rejection. This is where my ears started to pick up and say, okay, this is where I started to look at it and say, wait a minute, that's a little interesting. And it's the moment that my mind sees something in the market that says, whoa, that's a little interesting, that's the moment where I say, okay, let's take a look at this. There's something happening here, and there might be a trading opportunity for me here. So the market bounces, rejects off this level, and then it actually has 12 hours of buying. Not super impressive, but it does break the prior swing low here. That also piqued my interest. It didn't reject off the swing low and use it as resistance. It broke it, only to follow up with some immediate selling afterwards. In fact, the immediate 12 hours had completely taken out the 12 hours of gains here. So I said to myself, okay, we had an interesting bounce, but now we're right back where we started. Let's see what happens when we get to this level again. What happens with this candle is what most interests me. It opens at 90.66. It makes a low of 89.88. So it drops about 80 cents on oil here, and then bounces off the exact same level. It was literally the same level minus 2 cents, and then climbs back up right to the same resistance level here. Closes just below it. So rejects up and closes just below this here. Closes literally 20 cents off the high. So it drops 60, and then from 89.90 jumps up $1.55. I said to myself, well, wait a minute. We had a rejection here. We hit the same level, and buying interest must have come back in. So there are some strong buyers there that want to stop this thing from this declining any further. They're staking their line in the sand here. They decided to put their defenses there. They made a case for it over here, And then they've remade a case for it over here again. This time they ran into the swing low, and the pullback here, look at this. 1 4-hour candle of buying takes 12 hours of selling just to take it right back to where? The exact same level again. So now I say to myself, okay, this level is clearly defended. So I'm going to place a trade, and nicely, it's a round number, $90. So I said to myself, you know what? I'm just going to place a simple trade right at 90.05, cover the spread just above it. Going to have a 40 pip stop or 40 cent stop, nothing special. And what I'm going to do is I'm going to set my first target here, 91.45, just about 5 cents below that there. Now, the resulting candle eventually comes back and kicks me in. It didn't go that low. It only went to 68, so I was fine. I was like literally about 7 cents away from getting hit, but it wasn't that bad. So I was like, okay, fine, no big deal. So it then bounces, and I see 2 rejection candles to follow off of it. These 2 rejection candles were all confirming the same thing. This level is clearly defended. Somebody is there. Some large orders are there willing to defend it, and they keep rejecting it from getting off here to the point where the thing can't even close on 90. If it could close on 90, that wouldn't be as exciting for me. That would be less inspiring for me in terms of feeling that the trade would go further. But it kept getting rejected, so it kept saying, oh, okay, this is going to keep going higher. It eventually trickled in and hit my first target. At that point, I just said, you know what, move the stop to break even. And I had already decided what my targets were going to be based on not the previous support and resistance levels per se, but I said, you know what, let's take a look at this here for a second. This was the last move I was really concentrating on. And I said to myself, okay, let's take a look at this one here. Do any of these levels line up nicely? Well, this one lines up pretty nicely, but if we look at the overall scheme of things, it seems like it might want to make its way possibly to here, to here. After here, it could get pretty sticky. So I said to myself, let's extend this fib and see what happens. And this is where I really got some information. Let me delete these price spreads. This is where I really started to get some information. This first fib lined up with the previous support area, resistance areas right over here as well. The second fib lined up really nicely with this previous swing low here, and so did this one here. So they all lined up really, really nicely. And I said to myself, you know what? If I'm going to go for anything, I'm going to go for the 61.8, but I'm going to take another third of the position off here, and my final kahuna is here. Beyond this, it just has to fight through too much. There's a lot of price action above this level here, all the way up to 103. It could very well be starting a reversal and go all the way up to 103, but it seems like it would have to fight through a lot to get through here. So I said, you know what? I'd rather go for these nice little handsome targets here. So I said, okay, let's do that. So the price then, after a little bit of timidity, and I say timidity because look at how many candles it took to get past this level, and ironically, the 20 MA met up here as well. 1, 2, 3, 4, 5, 6, 7, and then 8 was the first one to close below it. So 28 hours later, the thing finally says, okay, we're ready to go. And it confirmed it, not just by breaking above it, but by this candle. This was the final confirmation that kind of communicated to me that, you know what, the chances of you hitting at least your next few targets are pretty high. You know, we're now $3 off the low. You have tremendous amount of buffer zone, but look at what happened all the way up to the 20 MA. 1, 2, 3, 4, 5, 6, 7. 6 out of 7 of them were all buying, all with wicks to the downside. And it capped it off with the next candle busting through, closing above, and closing towards its high, telling me the buyers are not taking their foot off the gas. More than likely, buying pressure is going to increase from here on out. If they had taken their foot off the gas, I would have seen a rejection on this candle here, but I didn't. So once this candle happened, it was kind of like, okay, I feel pretty good about this now. You know, I feel comfortable that I'll probably hit my targets, but we'll see how it plays out. Since then, we can see how this performed. First target, where was my first set of targets? Does anybody remember? That I would take 1/3? It's at the 50% Fibonacci. It came close on this next push, but then started to pull back. Now this is where I did a very brief price action analysis of this here. I took a look at this and I said, well, wait a minute. Does this look anything like a serious reversal of sorts? I said, well, it does have some elements of it. We do have a lot more. We have predominantly red candles. There are some decent rejections to the upside. So there was some elements of it. But take a look at this. This is one candle of buying. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 candles of selling, 48 hours of selling had not eclipsed 1 4-hour candles of buying. Who's in control? The buyers are. We know that because when one candle of buying completely outworks or out-hustles 12 candles of selling, that tells you that the sellers are working uber hard to push that thing down, and they're not performing. Whereas the buyers come in and say, look, I can outwork you in one candle. From there, the market pulls right back to what? 20 MA, which in a trend tends to support any sort of pullback. From there, the market climbs up again. 8 hours of buying eclipses 16 hours, actually more than that, 20 hours of selling. The market then stays within kind of a mini flag of sorts, pulls right back to the 20 MA again. Institutions say we'll use this again as support, and they further confirm that they are still participating in the market, they are still involved in the market by buying it again and buying with vigor. And finally, within the last few hours, my second target finally got hit. Took a little bit of time, but to me, no big deal. I don't mind holding positions for, we're talking the 27th up till the 5th. I don't mind doing that. Especially since I already had almost $1.50 locked up. That was plenty for me. I had no risk on the board, so why not stay in the trade? A lot of you might be saying to yourself, well, it's easy to stay in a trade that long when you have no risk. Not true. And I'll tell you why it's not true. And this is something you're all going to recognize. Is because all of you, and this is a question I get so often. Tell me if this is something that crossed your mind. One of the questions I get from traders is around this context. The general question is, how do you manage your trades once you're in them? I don't have time to be at the computer all day. Neither do I. I don't want to. I don't want to be out there every day. So, with that being, I don't want to be here all the time. In fact, I want to be at my computer a lot less than I am. Each year I've been trying to be at my computer less than I am. Because I'm not paid by the hour that I sit at my computer. I'm paid by how much I make per trade. If my trade hits its target, I make the same amount of money whether I'm glued to my seat at the computer watching it or whether I'm not and I'm doing something else. I make the same amount of money. Sure, by making adjustments in certain management things, I can increase or reduce risk and things like that. But for the most part, I'm not sitting there micromanaging my trade. My job is not to micromanage my trade. My job, once the trade is executed, is just to execute the trade as is. Go for my targets, keep my stop, follow my plan as is. All my management of my trade, all of the thinking should be done beforehand. All I'm doing at that point is just sitting there and following suit. If my job is to take profit at 91.45, then I take profit and move the stop to break even. If I'm trying to take off another third at the 50% Fibonacci, then I do that. If I have a final target of such and such, that's where I take my profit. My job is not to manage every single candle and to analyze every single candle and make a decision based on every single candle. This is something that so many traders do. This is something that a lot of you traders do. So a question that's probably been on your minds is, well, with a trade this long, how do you manage it? How do you manage it when you go to bed? How do you manage it? I don't do any more managing of it, really. All the decisions to manage it were decided at the outset. The only time I make an adjustment is if a unique event, a 5% event and 10% event comes out and tells me otherwise. It's so unique and such a strong anomaly that I can't ignore it. Other than that, 9 out of 10 times, I'm not doing anything different. So a lot of you think that, well, if, you could have taken, if this thing had reversed, let's say it reversed from the 20 MA, you could have said, well, you could have taken profit here and gotten out of it. Sure, I could have. But I don't know what the market's going to do next. Some person can come in, OPEC could come in, I don't have my OPEC's phones wiretapped or anything like that. OPEC could come in and say, we're releasing 200 billion barrels of oil or something like that. And then the price drops again or something like that. I can't control those things. There's so many things involved in trading global markets. You can't control anything. Your job is not to manage every single candle. Your job is to follow your trading plan, and that's it. So I don't mind staying in trades for 7, 8 days, because there's really not much for me to manage, and if it's going to hit its target, it's going to hit its target. If it's not, it's not. And I'm totally comfortable with that. You have to be comfortable with that. So, a lot of you may be thinking, God, such a long time to be in a trade. Sure. But guess what? I've made $6 off this trade. That's a pretty big chunk of change. I'm happy to wait to do that. I only need to make about 3 of those a month to make my nut, and that's it. It's not how many of those big trades do I need to completely hit my goals for the month? And how many trades do you have to make on a monthly basis to hit your goals? I don't really have a particular goal, but I feel pretty comfortable if I make a certain amount of pips or dollars or whatever in whatever instrument I'm trading. So with that being said, the only adjustment I had to make is now that we've hit our 50% target, I had to readjust my stop again. Any guesses as to where I've readjusted my stop at this point? Any guesses? And then I'll get into some of the questions here. Actually, I'll save the questions towards the end. 94.66. Very good. Los Peños, very good. Just below that. Actually, just below this candle here. I put just below the Fibonacci here. It's 30 cents. It's no big deal to me. Fibonacci is a great support resistance level here. 20 MA behind it. I put it right here. We've hit our first target. That's it. At this point, I'm done. There's nothing left else for me to do in managing this trade. It's either going to its final target, 97.45, just shy of the last Fibonacci, or it's not. If it continues to sit above this 50% Fibonacci, maybe I'll bring my stop up just below it. But other than that, there's really nothing else for me to do at this point. So with that being said, and very good for Los Peños, good guess on that. With that being said, is everybody able to understand the concepts and the things I did to spot this trade? Does everybody get the concept of price spreads? Does everybody get the concept of what kind of order flow behind that is involved in creating these kinds of price spreads and moves? Does everybody understand the concepts I was using to choose targets? How I was analyzing these different candles? What those candles were communicating? Does everybody understand all that? Does that make sense to everybody? If it doesn't, tell me. I'm okay with that. I'll be happy to re-explain it. Yes? Does this feel like things that you can also integrate into your trading? That's more important to me. Not just that you understand it. Can you integrate things like this into your trading? Sorry, I had to take a drink of water. Yes, no? Carly says, could you re-explain the spread, please? I'd be happy to. Clear as a tango step. I don't know, Blakey, if they were some of my tango steps, it might not be so clear. It's funny, I live in the country where tango pretty much, is just like, it's like tango and football are like two ridiculously, tango, football, mate, and corruption are like the most dominant things here in Argentina. And for living here for several years now, I started off getting really good at it, but breaking up with the tango teacher kind of put a curb on that. So since then, I haven't been as inspired to go back into the tango cliques and circles and things like that. I do want to, and it's funny because when I moved here, it was such a goal of mine to learn tango. What did I ended up learning and becoming really good at? Archery. Not sure how that works out, but anyways. What is mate? It's a different type of, it's a herb type drink. It's a caffeinated drink that's religiously drank here in South America, particularly in Argentina. Okay, so let's get into some of these questions here. What brand of new computer? It's not a brand. It's not like Acer or Dell. We built the thing from scratch. So we, Asus motherboard and, crazy, memory and chip. The chip is, different. It's not one brand. We built it. We just built it. I have a store here that can build these things from scratch. So it's got all kinds of things. Junji says, hi Chris, do you mind explain how you derived the spread? Was it just visual? Yes, the spread really, and this will answer Carly's question too at the same time. The spread really is just visual. What we're doing is we're looking for a trending type move that has a series of impulsive versus corrective moves, followed by impulsive move in the same direction as the original one, followed by a corrective move, followed by an impulsive move in the same direction. So what we're doing is we're really measuring the price spreads from impulsive to corrective to the swing low, making new swing lows, but it has to be impulsive moves following the previous impulsive move. So if the original impulsive move is down, the next following impulsive move is down as well. That series has to stay intact. So that's what we're doing. What we do is we look for an impulsive move. We look to see where it stops. We kind of mark it visually. And then we see where the next impulsive move, once it breaks this low, where's the next major low it finds. And that is a price spread. Then this last one here, we have down here, that's another price spread. And we break this low, boom, and here's another price spread. So it's really just visual. But it has to be a trending type move that is supported by impulsive moves that are continuing in the same direction as the original impulsive move. If it runs into a counter-trend impulsive move, then that's the end of that series. And that's something I've been talking about for months on this class. So hopefully it answers your question. And hopefully, Carly, that answers your question as well. If it doesn't, please let me know. What percentage are you a tech trader and what percentage are you a fun trader? It's all fun for me. But I think you meant fundamental trader. I would say 95% tech trader. And when I say technical, I'm really talking about, Ichimoku, price action, all these things. Those are all within the technical realm. So 95%, 5% fundamental, and that's it. Do you use the dollar index? I do use the dollar index. I actually like, and I'm waiting for FX Trek to get this set up, but I prefer FXCM's dollar index, and the reason why I like FXCM's dollar index is because it's more weighted properly. The current dollar index that most people are exposed to is so heavily weighted to the euro that it's almost like trading the dollar against the euro. It's really like, it's like a gang of 5 with one major henchman, which is the euro, and then a bunch of little midgets, and you don't really worry about the other guys, you're kind of worried about the big guy, and that's the euro. It's like 54% weighted against the euro. And so because of that, the older dollar index, I find it to be an antiquated version of a dollar index. FXCM's new version of it, their Dow Jones dollar index, that one to me is evenly weighted. So I find that to be much more, accurate as a dollar index because it covers the major basket as a whole and gives them all equal weight. So hope I answered your question. Do I use the dollar index to set up my trades? No. But I do like the dollar index as a trading instrument. I don't use the dollar index to set up my trades. I don't need to. I don't need to, never have, never needed to. You know, I can get clear communications off of the chart here. I get all the communications I need. Okay, so Carly, hopefully I've explained the price spreads. If I don't, let me know. Mind Humble says, you pointed out that the big blue candles show bullishness because even 12 candles couldn't reverse it. But yet the massive, and I'm trying to think of which one, this one here. Okay, great. But yet the massive red candle, which also had a bounce back, you said was an indication of a reversal. No, I didn't say it was an indication of a reversal. That's not what I said. I think you're talking about this candle here. What I did say is that I said it's an indication of a rejection. And let me go back and cite the reasons why. It's an indication of a rejection, not a reversal. And the reason being is because in this leg right here, the last three candles were all increasing in selling pressure. Little size, bigger size, gigantic size, meaning that the selling pressure was increasing throughout those three candles. And the reason why I said that it was indication of a type of rejection and not profit taking was because it had maximum selling pressure during this candle. This candle opened and it didn't go 1 cent higher. It sold off 3 cents, $3.08 in one candle. But it ran into the 90 level, just actually a shade below that, and had rejected 25% of the entire selling pressure. So for something to have all this momentum coming into this candle, and then for this candle to be the expression of maximum momentum and selling pressure, only to run into a line in the sand and reject 25% of the losses that it had accrued, communicated to me that there was a rejection. Wasn't indicative of a reversal, it was indicative of a rejection. It was a combination of the following price action after that include me into likely reversal. So does that help clarify it? Because there's a difference between what you said and what I said. Does that make sense there? I just want to make sure we're on the same page here. Yes, no? Hopefully it does. Okay. So I could say the same with the blue. No, I couldn't say the same with the blue. I didn't have a rejection on the opposite, a massive rejection that was over 25% of it. This one right here was 5% of the entire candle, not even, maybe less. So I can't say the same of this blue candle here. If anything, I can say, I'm talking about the top here, because on this one here, let's not use tail or this and that. Let's just use the bottom portion of the rejection. This candle's expression was selling. So I got a rejection at the end of the selling here. That's different than this candle where I got a rejection in the beginning of the candle. That would be, if I was to take that wick and transplant it, it would be over here. That wouldn't be in response to a particular level per se, and it wouldn't be in response to maximum selling pressure. This was, it opened, it sold off a little bit, then buying pressure came in and increased off of it. They're two different candles. If I had a strong rejection on the top end of this candle, then that would be different. So hopefully, okay, great. It seems like you got it. Okay, great. After John G, there's somebody named One. Cool name. When did you stop trading 1 hour time frames? Because I listened to your older webinars where you said you trade 1 hour and 30-minute Ichimoku. I don't trade 1 hour and 30-minute time frames for price action. So 95% of the trades I'm talking about is in reference to price action trades. I have Ichimoku systems that actually trade off the 5-minute time frame. So Ichimoku, I consider that a completely different genre of trades. When I'm talking about all the price action trades I'm making, the bulk of them, I'm talking about within the bulk of all the price action trades I've made, 95% of them will be on the 4-hour and daily time frames. I don't need the 1-hour time frame to make a price action trade. So hopefully that clarifies it there. My apologies. Trying Trader says, what did you mean if it runs into a counter trend impulsive move, it is all over? Can you show an example on a daily chart? Probably. Let me see if I can find you one. There we go. There's a good example. A couple good examples, actually. Massive selling pressure here. Boom! Big impulsive move, subtle pullback, and gigantic impulsive move, counter trend direction. Same thing here. Strong selling pressure. Boom! Counter trend impulsive. So those are, and sorry for the intensive sound effects there, but those are counter trend impulsive moves. John G says, hi Chris, overall this pullback from 89.60, hold on one second, let me get back to the chart there. Overall this pullback from 89.60 to 97 still looks corrective than the impulsive move down from 102. Wouldn't you see it that way? This pullback from 89.60 to lows 97. I think I need to go to a larger time frame. This move right here, 89.60 to 97, still looks corrective than the impulsive move down from 102. I'm going to say no, and here's why. I can see why you would say that, but I'm going to say no. And here's why. Maybe you're short, you dump oil, and I'm hoping that it'll still be that way. So, first of all, we already talked about the price spreads as reflections of how the market was decreasing in pressure at the very end and ran into some stiff buying here. But also look at the expression of the price action on this leg here. You notice how the candles are increasing in size, and they end off with the expression of the largest candles at the end. That is a reflection of little buying pressure, increasing buying pressure, more buying pressure, maximum buying pressure. On top of it, you can only find 2 red candles in like 12 blue. But then look what happened since then. Impulsive. I would call this a corrective move since then. Corrective in that it never really actually takes out the lows of this candle. And they're talking 20 candles here. And we can't even break the 20 MA, finding higher highs and lower highs. And responds with 2 candles that completely annihilate all that selling and make a new high. So overall, I mean, this candle's not done. Who knows what it'll form. But overall, I would not consider it a corrective move. If it was corrective, it would probably remain in the vein more of looking like this. And if you want to, you can check out, I have a video on my site which talks about impulsive versus corrective moves. It's a free video. If you understand, if you remember, I always described impulsive versus corrective move with 3 characteristics. 3 characteristics of an impulsive move and 3 characteristics of a corrective move. Then when you break it down, those 3 characteristics, it will also come down to showing that this one's more impulsive. So that's my thoughts on that one there. Hopefully that helps. John G also says 97.51 lines up with the 6.8 of the whole move in regards to the previous QT. That's true, but just because there's a Fibonacci in the way, and that Fibonacci may be the 61.8, doesn't mean all the price action between the 100% and the 61.8 is corrective. Why does it have to be? There's nothing that says all the price action between the end of the move and any retracement back to the 61.8 has to be corrective. Why can't it be a counter? Why can't it be an impulsive move that's completely taking out the previous corrective move? Nothing forbids that. It's completely permitted. So hopefully that answers your question there. Boyke says, what do you think of scalping? He says, I don't. You know, I'd have almost the same response. I really, you know, again, I don't find scalping to be an effective system because it's very hard. It's very, very hard to replicate scalping and make that effective. You know, I said this again, and I'll tell you this story one more time, is that, there were thousands of traders, when I was at FXM. We were at roughly 60,000, and we tested, the top 1,000, and then the top 100, and then the top 10. And out of the top 100, only one of them was a scalper. And that communicated to me very early on in my career that if scalping was such an easy thing to do, we would have a lot more people that would be effective at it within the set of profitable traders. But actually, almost all the profitable traders had very similar characteristics, and they were on the opposite end of the spectrum from scalping. So, and you'll see that today. Recently there was a study at the end of 2010, all the brokers had to report in how many of your accounts are profitable from the moment they open to where they are now. And 25% of the accounts were profitable across the world globally on average. The highest region was Asia with 40%. And what was the most common characteristics? They were trading on longer time frames and holding their positions longer. The scalpers were the smallest percentage of that group of profitable traders. So, to me, it's just something that isn't repeatable very easily. It takes an incredibly sophisticated system. And really, nowadays, to be a good scalper, you'd almost have to have it be algorithmic. And that's just not easy to build that, almost in the realm of high-frequency trading. And, to do that, you need to understand high-frequency mathematics and really understand how that works. It just requires so much sophistication that it's not really accessible to the average retail trader. So and it requires massive internet lines and just so many things. And, it's like, why would you go through all that work for something that's very hard to repeat? Why not try something that's pretty easily repeatable? I have traders emailing me every single week using these systems. One guy literally sent me an email saying, "Hey Chris, my wife wants to thank you," and I was kind of confused, and I didn't say anything about it. And then he's like, he emailed me the next time and said, "Hey, since you didn't ask about," let me look at it. "Since you didn't ask for my last email, my wife says thanks for helping us with the remodeling of her kitchen. Ichimoku and the ProForex courses have really helped and covered the expenses here. Thanks again." So, here's a guy helping me saying, hey, he's using these methods, and he's able to remodel his kitchen with it, which is not a cheap thing to do, and he's only been with the courses for, a few months now. So in a few months, he's able to repeat that. I would have to be hard-pressed to find somebody who can take a scalping system and do the same. In a couple months, that's it. They're, profitable. I have people emailing this all the time. One other email here is from another guy. Guy's name's Nazar. I think he's from Canada. Chris, thanks again, Chris. My trading account is now valued at $34,000, $28,000 when I started with these courses. Over the last 2 weeks, I'm averaging about $600 a day. My goal is on average to make about $1,000 a day, and then we get into a long discussion there. So, there we go. And this guy's been with the course less than 2 months. So, easily repeatable. Anyways, that's my thoughts on scalping as a whole. So with that being said, I'm getting the curtain call and the cane is coming around my neck trying to pull me off the stage. Those people are FX Street. So first of all, I want to thank FX Street for recording this. Thank you all for being very patient regarding all this. All of you guys have been fantastic, great participation as a whole. I hope to see you guys next Tuesday. Also check out my blog on forexstreet.net. I'm always posting new articles. I usually post towards around the beginning of the Tokyo session. If I have time and I'm not trading in the morning, I usually post another article around just before London close. So always check out my blog, and I'm responding to other articles and posts and stuff like that. I'm active on it daily, so check it out. Please join. In the meantime, I bid you all adieu. I wish you all good luck trading. If you have any questions about our services, check us out, secondskiesforex.com, or if you have any questions about our courses after viewing the website, email me, info@secondskies.com. Until then, I bid you all adieu. I wish you good luck trading, and I'll see you guys next week. Take care, everyone.